Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories inside company financial reports. And today we have a doozy, a deep dive into Helio Corporation's annual filing, something that looks like it could be charting a course through the stars, but maybe with a few turbulent zones. Helio Corporation, a company in the aerospace game designing and building spaceflight hardware, is giving us the lowdown on their performance over the year, ending the 31st of October 2025. They are all about enabling humanity's pursuit of science and business in space, touching everything from lunar exploration to potential space-based solar power. Now, before we get into the nitty-gritty, they put out a big warning label about forward-looking statements. This is pretty standard stuff telling us that many of their plans and projections use words like believe, expect, anticipate, and are based on a lot of assumptions. They are basically saying that while they are aiming for the stars, the actual journey might have unexpected turns, and what they think will happen might not actually happen. Keep that in mind as we look at their numbers. Getting into the meat of it, Helio Corporation is reporting some interesting figures. The company's common stock is trading on the OTC market under the symbol Helio, and they have some big plans for expanding into space-based solar power. This is a huge ambition, aiming for a market that's already massive and expected to grow even bigger. Meanwhile, they are currently operating with a very lean team with only about 12 employees as of February 2026, which is quite small for a company with such grand ambitions. This small team size raises questions about how they will manage such complex projects and growth. They highlight several competitive advantages, including an experienced leadership team that has a strong track record in space science and hardware development. They have been praised by NASA and have repeat customers, which is a good sign. They are also positioning themselves as a leader in lunar exploration hardware, and services a truly exciting space to be in right now, given the renewed interest in the moon. They also emphasize their system-level design expertise, which lets them offer more comprehensive solutions compared to smaller niche players. Now let's crunch some numbers for the year ended the 31st of October 2025. Revenue took a hit, dropping by a significant 44% to just under $3.9 million. This is a big change from the prior year where they brought in nearly $6.9 million. They attribute this to budget cuts in NASA programs and a government shutdown. This shows a heavy reliance on government contracts, which, as they point out, can be quite volatile. Out of 11 customers they served in 2025, only 2 were direct government customers, with others being subcontractors or private entities. The fact that over 67% of their revenue came from just 3 customers in both 2025 and 2024 really underscores this lopsided revenue stream. Cost of revenue also decreased by 29%, but as a percentage of revenue, it actually went up. In 2025, costs of revenue hit 75% of their total revenue compared to 60% in 2024. This jump indicates that even though they had less work, their costs did not shrink proportionally, and in some cases even went up relative to the revenue generated. The company mentions a loss on a fixed price contract and charges on a services contract beyond allocated hours, which points to some execution challenges. Looking at operating expenses, they went up slightly by 3% to about $4.6 million. The biggest jumps were in professional fees, likely due to efforts around a public offering attempt and general administrative expenses. This increase, despite the significant drop in revenue, is a point to watch. All of this paints a picture of their bottom line. The operating loss widened considerably to almost $3.7 million from around $1.7 million in the previous year. Essentially, their operating expenses grew at a much faster pace than their revenue. And when you add in interest expenses and other costs, the net loss for the year ended the 31st of October 2025 ballooned to over $4 million. That's more than double the net loss of about $1.86 million in 2024. This growing loss is a major concern for the company's financial health. Speaking of financial health, their cash situation is quite tight. As of the 31st of October 2025, they had a mere $7,305 in cash and cash equivalents. This is a drastic drop from $551,552 the previous year. They are heavily reliant on ongoing debt and equity financing to keep the lights on. The company essentially states that without additional financing, they may need to scale back operations, delay strategic initiatives, or even consider other strategic alternatives. Their debt is also a significant factor. As of the 31st of October 2025, they had over $1.3 million in notes payable to related parties and over $1.8 million in notes payable to unrelated parties. The maturity dates are looming with a substantial amount due in 2026. The company has received multiple notices of default on several promissory notes, which adds a layer of immediate concern to their financial stability. The fact that they are in discussions with holders but with no guarantee of resolution means this debt is a major risk. When we look at cash flows from operating activities for the year ended the 31st of October 2025, the company used $2.065 million. This means they are burning through cash just to operate their business. Their negative operating cash flow of over $2 million is mainly driven by their large net loss and changes in working capital items. It is interesting to note the significant increase in stock-based compensation. In 2025, it was $431,005, up from $196,437 in 2024. While this can be a good way to motivate employees, it also means a dilution of ownership for existing shareholders. The company has authorized a massive 100 million shares of common stock, but only has about 11.3 million issued and outstanding. This flexibility in share issuance could be used for fundraising, but also means significant dilution could occur if they need to issue more shares to survive. Now, for the auditor's report from Astra Audit and Advisory LLC, they confirm that the financial statements present fairly the company's position, but they also flag substantial doubt about Helio Corporation's ability to continue as a going concern. This is a serious warning directly from the auditors, stating that the company's financial situation is so precarious that it might not be able to continue operating for the next year. This is largely due to their recurring net losses and dependence on future financing. On the controls front, management acknowledges that their internal controls over financial reporting are not effective due to material weaknesses. These include a lack of personnel with enough accounting expertise, issues with reviewing non-routine transactions, and problems with the financial closing process. They are working on fixing these, but admit they cannot guarantee success. This lack of strong internal controls is an extra layer of risk for investors. Looking at the leadership side, we see some fairly recent changes. Edward Cabrera stepped in as President, CEO, and Chairman in January 2026. His background is in investment banking and portfolio analysis with extensive experience on Wall Street. He also has an engineering degree and an MBA from Harvard. The board believes his experience in capital markets and corporate strategy makes him well qualified. Gregory T. Delory, who was the CEO, transitioned to Chief Technology Officer and remains on the board. His background is in space science and he was a co-founder of Heliospace. His expertise in space missions and instrument development is highlighted as valuable experience for the board. So what is my take on all of this? Helio Corporation is operating in a very exciting and potentially massive market aerospace and space-based solar power. They have a leadership team with relevant experience and some key NASA contracts that validate their technical capabilities. However, the financial picture is quite concerning. The sharp drop in revenue, a widening net loss, and extremely low cash reserves, coupled with significant debt and multiple loan defaults, paint a picture of a company struggling to stay afloat. Their heavy reliance on government contracts makes them vulnerable to policy changes, as we saw with the proposed NASA cuts, even though those were later restored to some extent. The move towards space-based solar power is ambitious and could be a game changer, but it demands immense capital, innovation, and execution. Given their current financial precariousness and the need for substantial additional funding, executing such a daring plan seems like a very long shot without major financial backing. The material weaknesses in their internal controls also add to the risk profile. In essence, Helio Corporation is a company with a potentially brilliant but very distant vision facing significant immediate hurdles. It is a very high-risk, high-reward situation, much like betting on a rocket launch, where there is always a chance of a spectacular success, but also a significant chance of a costly failure. Investors would need to be highly confident in their ability to secure massive funding scale-up operations and navigate the complexities of both the aerospace industry and their current financial distress. Alright, that is our deep dive into Helio Corporation's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think their ambitions can overcome their current struggles? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more corporate breakdowns. And as always, check out the Discord community linked in the description for more insights and to connect with other corporate explorers. Thanks for watching, and we'll see you on the next Decoding.